Good morning, good afternoon, and good evening, everyone. I'm Stephanie von Friedeburg. I'm the Senior Vice President of Operations for IFC. I'm excited to be here today to talk about debt restructuring. This is a series of events that we started as a result of the COVID crisis, knowing that there is a looming potential for substantial bankruptcies and needs for restructuring in emerging markets as we come through the COVID crisis. We have an incredibly distinguished panel with us today. I'm excited to be able to talk to all of them. Each of them brings a very different set of skills and experiences to enrich the conversation. To kick us off today, we have a keynote speak from IFC's new Managing Director and Executive Vice President, Makhtar Diop. He's been in his job for 3 weeks, and we are incredibly excited to have him leading the institution. So Makhtar, why don't I hand to you for the keynote?
Thank you so much, Stephanie, and thank you all for joining us today for this important discussion on corporate debt restructuring. I've joined IFC at an unprecedented time. While we are hoping for better times ahead, the pandemic has reversed a decade's worth of gains on the human development front. On the economic front, businesses of all sizes have been affected, jobs have been lost, investment have dried up, and corporate debt is skyrocketing. Corporate debt in emerging markets and developing countries was already at a historic high prior to the pandemic. Total public and private debt reached a record high of almost 170% of GDP, estimated to $55 trillion in 2018. That's an increase of 54 percentage points since 2010. And we have documented it in a recent report led by our colleague Kos and some other colleagues. The COVID-19 crisis did not start as an economic crisis, but its impact on businesses was quickly felt. Our latest Business Pulse survey shows that the average drop in sales in the first 4 weeks following the peak of the shock was between 60% and 75%. Although almost 90% of businesses were open after 10 weeks, from the peak of the outbreak, the negative impact on sales was a major burden for firms. The duration and severity of the current economic shock undermines firms' capacity to repay their debt. A potential consequence of this grim picture is we will have increased bankruptcy filing. And as government support programs recede, the risk is most acute among small and medium enterprises in emerging economies. Low-income economies and smaller firms, which have fewer assets to avert insolvency, have indeed been hit disproportionately. In service sectors like tourism and transportation, these firms are particularly at risk. These are also the businesses least likely to receive support from the forbearance policy that helped delay the tsunami of bankruptcy filing in 2020. With government phasing out unprecedented support to business, we will likely soon witness a significant spike in non-performing loans and corporate insolvency. Pre-pandemic insolvency systems were not prepared for this rapid rise of corporate debt that occurred in 2020. World Bank data on resolving insolvency shows that 75% of economies around the world, an insolvency yet viable business will not survive. This has a detrimental impact on the creditor recovery rate. We are talking about it in our 2020 Doing Business report. As a result, we should expect an increase in bankruptcy filings. The credit insurance company Hermes referred to it as an insolvency time bomb and expects its global insolvency index to hit a record high of plus 35% in 2021, with half of the country recording a new height since 2009 financial crisis. And unlike in the 2007 and 9 crisis, all regions and economies are expected to post double-digit increase in insolvencies. But the effect of the pandemic on corporate insolvencies and resulting credit losses are only starting to be felt. According to the Bank of International Settlement, BIS, corporate credit losses between 2020 and 22 could be 3 times the pre-crisis level on average across the G7 economies, China and Australia. These additional credit losses will amount to slightly more than 2% of annual GDP or $1 trillion, and that's an estimation that Morgan and al. Did recently in 2021. So how do we mitigate the risk of this impending bankruptcy tsunami? Never has it been more urgent to focus on the importance of a robust legal and institutional framework. The insolvency regime, the enforcement system, and the environment to achieve out-of-court workout are essential building blocks for corporate debt restructuring. Insolvency and credit debtor rights, ICR regimes, are one of the tools in the policymakers' arsenal to contain the growth of non-performing loans, and that's something that was very well discussed in a recent paper by Menendez and Muro in 2021. Internationally recognized benchmarking mechanisms such as the World Bank principles for effective insolvency and creditor and debtor regimes, as well as the World Bank data on resolving insolvency, can help policymakers identify necessary good practices and define the recovery policy agenda. Laws and regulations should also allow investors to enforce their claims against collateral efficiently and provide efficient mechanisms for out-of-court restructuring and efficient in-court insolvency processes. These are crucial pillars to attracting investors and creating a market for distressed assets. A functioning distressed asset market, in turn, helps viable firms return quicker to productivity. It also helps limit the movement of solvent firms into liquidation. However, reform efforts should not only focus on upgrading the legal framework. There should be a period of triage, focus on the institutional reshaping and understanding of the risk of the evergreening. Banks should be expected to produce reliable information on loans that have benefited from borrower relief measures. That's a very important point in the current situation. Prolonging exceptional borrower relief and short-term legal measures carry hidden costs, including a weakening of repayment discipline, allocative inefficiency associated with zombie borrowers, and a possible adverse impact on banks' liquidity. The temporary and extraordinary nature of these measures need to be well understood by banks, policymakers, and by the general public to avoid that they become permanent fixtures. Economies worldwide will greatly benefit from government reviewing and adjusting insolvency framework. They must reflect the unique circumstances of the crisis and focus on restructuring and saving viable companies. While there is no one-size-fits-all solution, I look forward to hearing our distinguished speakers speak about the critical building blocks needed to reform and facilitate restructuring. So let me now give back the floor to Stephanie von Friedeburg, our IFC Senior Vice President for Operations, who will lead the discussion with a distinguished panel of practitioners and academics who have been working on this issue and will be able to provide us with some insight on how to address this crisis. Back to you, Stephanie.
Thank you very much, Makhtar. Very good framing for what is the second event in a series on debt restructurings as a result of the COVID crisis. As I said in my introduction, we really do have a very distinguished panel. So let me first introduce our panel. We have Dr. Reza Baqir, who is the governor of the State Bank of Pakistan. He is also an 18-year veteran of the IMF and a former member of the World Bank. So welcome, Reza. We have Hal S. Scott, who is the Emeritus Nomura professor, founder, and director of the Program on International Financial Systems at the Harvard Law School. We have Jamie Sprayregen, who is a restructuring partner in the Chicago and New York offices of the Kirkland and Ellis law firm. He is recognized as one of the most outstanding restructuring lawyers in the United States and around the world. We're very glad to have you, Jamie. We have Ramiro Alfonsín, who is the Chief Financial Officer of LATAM Airlines Group. He is part of the team that is currently taking LATAM through a restructuring in a complex and multi-jurisdictional way. And finally, we have Rosa Sacre, who is the Managing Director responsible for asset recovery and restructuring at Société Générale and has considerable experience in our countries of operation. So Rosa, welcome. I am very glad to have you all here. We are actually streaming live on the World Bank. We have several thousand people connected. For those of you who are watching, you can follow us on Twitter at World Bank Group Finance and at WBG Finance. Those who are watching can also participate in the conversation and post questions on the Twitter using hashtag #InsolvencySeries. So with that, let us now get started. I want to start with you, Jamie. As you've been very active and successful in helping U.S. and international companies through insolvency. And in 2020, we have certainly seen a wave of bankruptcies and insolvencies across markets. Hertz in the United States. We have LATAM with us today, who's in the process of many restructurings. You represented United Airlines in the mid-2000s when they went through a restructuring, so you're very familiar with the airline industry, which is one of the sectors we've seen hardest hit globally. What are you advising businesses now that they are being disrupted by COVID? Is it mostly about weathering the long-lasting storm or about making fundamental changes to the way that they're operating their businesses?
Well, first of all, thank you very much for having me, and I'm honored to participate with the other distinguished panelists. What we have been advising is actually both of what you just referenced. A number one priority is not to run out of money. So I would say liquidity. And you really can't get to making fundamental and transformational changes if you run out of money, because if you run out of money, you're not operating. So in the world of prioritization, and we just heard from our keynote about triage, I couldn't agree more with that. But that's just the start in the sense of there's a phrase attributed to lots of different people. I'm not sure who said it first, but never let a good crisis go to waste. And there is an opportunity, assuming you address the money issue and the liquidity issue, to then take into account the problems caused by COVID. But my experience has been that some of the companies' problems are completely COVID related. Obviously, the airline industry is one where travel just collapsed. But there's other industries. We've done a lot of, say, retail restructurings over the last year. And I think maybe in that industry, COVID could be blamed, but it more accelerated what was probably going to happen anyway. And so I think you need to distinguish that. And then there's a lot of in-betweens. But this does tend to, this crisis has focused companies on, as I said, number one, liquidity. And we've helped a lot of companies just buy time. And then once you take a breath and buy that time, you say, what can we be doing different to better ourselves during COVID? And then what wasn't really caused by COVID, it just caused the problems to more quickly accelerate and manifest themselves and address bigger issues too, so companies can operate in a better way going forward once we come out of this, which hopefully we are in a slow way in the next bit. I won't get into medicine. So I'll stop right there. Hopefully that's helpful.
Very interesting, Jamie. We actually, and IFC have looked at this in a 3 R's frame. And the first frame was relief, which we really defined as providing liquidity to our existing clients, knowing that liquidity was the key to making it through the crisis. So very interesting. Hal, let me turn to you. The program that you founded on international financial systems at the Harvard Business School is the principal organizer. Harvard Law School, sorry, my mistake.
Yeah.
Sorry,
Yeah.
Is the principal organizer of the annual U.S.-Japan Symposium on Building the Financial System in the 21st Century. The symposium really started during what was called the lost decade, or the period of economic stagnation in Japan. Are there lessons learned that could be derived from the symposium and what you've taken away from that symposium for other economies to adopt and to address this increasing concern that I think what Jamie referred to as firms that might have been on their way out of business but were accelerated by the COVID crisis?
Well, thank you again for having me, and I'm happy to participate with this very distinguished panel. I would pick up where Jamie left off, which I think the first thing you have to have is a legal structure for dealing with insolvent firms. And a key part of that is the ability of creditors to put debtors into bankruptcy or to engage in something outside bankruptcy, which is equivalent to it. And Jamie would be the expert about how to do all that. But you need a legal structure in place. And Japan had that. But the problem in Japan was so-called zombie firms. And what was that all about? So banks had made lots of loans to various companies. And those companies were in trouble. They were suffering huge losses. If the banks declared those companies to be in default, they would write off their loans, which would impair the capital, and put the banks themselves into difficulties. So as a result of that, for many, many years, the banks delayed recognizing these losses, to some extent aided by the government. The government's attitude is push the ball down the road. Why do we want to endanger our banks? If we do endanger our banks, we're going to have to bail them out. Where are we going to get the money to do that? So let's just push this ball down the road. Well, they pushed it down the road, and every time they pushed it, it got worse. So at the end of the day, what was a serious problem became a huge, enormous problem, which required the entire restructuring of the Japanese banking system. Okay. So I think one of the lessons learned in Japan is to fess up to the problem and deal with it as soon as you can. And I think a key part of that is the bank supervision process. You have to have supervisors go in, check the bank's accounting. Are they accurately reporting non-performing loans? Throughout the decade, non-performing loans in Japan were seriously underreported. So that's something I think, from a World Bank point of view, you should want to, encourage better supervision. At the end of the day, however, and who knows what the level of this is going to be in COVID, recognizing these losses do imperil the capital of banks. So you now have to turn to the question of what you're going to do about that, okay? And there are not going to be a lot of easy answers. In the West, after 2008, because we didn't want to bail out banks again, we tried to create a resolution system and higher capital requirements and all sorts of things that would kind of cushion a crisis. If the country doesn't have that, then they really have to come up with the money, maybe you can help them, to kind of bail out their banks. It's a very important thing to get these non-performing loans off the balance sheet of these banks. Okay, so banks continue to function. You then put the loans in some kind of agency, which Japan did, and you do workouts. By the way, China, made a similar approach by creating asset management companies to buy non-performing loans from banks when they had difficulties some years ago. So that would be my general approach.
Very interesting how we certainly, with the forbearance that has gone on, have not seen in the banks in which IFC works substantive effects on their balance sheets yet. And my concern is when the regulatory forbearance is lifted, what's going to happen to the balance sheets of those banks, which I think, Rosa, brings me very naturally to you, given what you do in relation to Société Générale. Are you seeing in the clients that you're working with in different markets, different kinds of fallout? And how is it working vis-a-vis the regulatory regimes in the different countries in which you work? I know you mentioned Ukraine earlier. Maybe there are some other emerging markets where you're seeing it working better or you haven't really seen an effect yet.
Thank you very much. Good morning to all, and And again, it's an honor to be on this panel and to represent Société Générale. I work in asset restructuring and recovery management. It is a global team working in EMEA, Asia Pacific, and we also have a similar setup for the Americas. So we work for corporate investment banking clients as well as for corporate clients on our domestic and international retail banking. Now, COVID shutdown provoked a massive shock, and things were put in place swiftly, quickly. A package of credit, regulatory, fiscal measures have been deployed by the government. And for the state-backed credit facilities, the government used the distribution network of financial institutions. We have it in France, BPI France, which is a public investment bank, which was one-stop place for the management of state guarantees. As a team, we've been very much involved in the structuring, in the approval process, and the distribution of state-backed credit to preserve the going concern, the value of our clients, and to help them close their liquidity shortfalls. Now, we put in place something like 18 or 19 billion credit-backed facilities. So far have been dispersed, and both retail and corporate, large and SME, could reach out and get this cheap credit. When we look at other countries, other emerging countries, in particular on the African continent, where our bank has a large footprint and where the lockdowns were less strict and overall differently managed, we saw a combination of regulatory and liquidity measures. For instance, in North Africa, we saw Daman Relance and Daman Oxygen loans being disbursed. Sometimes we saw specific measures for the hospitality sector. In Tunisia, there were directives asking banks to defer the installments for retail clients. And we saw also regulatory reliefs for provisioning and forbearance rules in Western African and in Central African countries. Then in Russia, where our bank has a presence through the universal bank Rosbank, there was the whole spectrum of regulatory stimulus and tax measures which were deployed. Now the question is, what did we do when there was nothing done by the local government? We did take measures. We provided postponement and restructuring solutions for the clients, even though it was clear that it was the government, the lender of last resort. But we did this to handle this health crisis. From the risk analysis point of view, it was very difficult to put an opinion. A company having zero revenues for the last 12 months or a company having zero capacity to service the debt is a company that has criteria for a non-viable business. So now 1 year passed, and of course the market expects impaired loans to rise as the state support will diminish. What will happen, we will see. We need probably some more time to analyze COVID consequences. What is true is that some companies will not survive and others will certainly reimburse their facilities in advance. Thank you.
Thanks, Rosa. Reza, let me come to you. I think Hal said he thought it was important that governments intervened early to try to ensure that banks didn't end up with a series of non-performing loans and kind of kick the can down the road. Rosa was talking about different countries taking different approaches, I think with the developed world and the developing world being very different. As the governor of the Central Bank of Pakistan, you have been engaging very actively to help clients. What has worked really well for you in the emergency COVID facilities you've made available? What hasn't worked so well? And how long do you envision the government continuing to intervene to bring the country out of the crisis?
Thank you, Stephanie, for first of all having me here. Let me begin actually by appreciating the fact that the World Bank is organizing the series of talks on this topic of corporate restructuring. It's not only important from the perspective of economies quickly recovering in terms of growth, but it is also a very important perspective that sovereign debt not increase because in some countries, banks and ultimately governments have to bail out banks that have had NPLs problems that have not been able to resolve. So really welcome these series of talks. In Pakistan, when the COVID crisis started, we overall we found ourselves in a constraining situation that Pakistan is a country that has high public debt at nearly 80% of GDP. And therefore, the response to COVID had to lean a lot more on the monetary policy and monetary instruments rather than a fiscal expansion. Because after COVID, if Pakistan ends up with a much higher debt to GDP ratio, it would actually undermine the goal of restoring financial stability because markets are not very generous or forgiving towards emerging markets with high public debt that have previously had balance of payments crises. So overall was the recognition that our monetary policy tools and related financial tools had to take more of the burden. Very early on, one of our key measures was to introduce a voluntary scheme whereby, working with the Pakistan Banks Association, we came up with the policy that if a bank's client comes to a bank and asks for a deferment of the principal payment on the loan for up to a year, the banks normally would be expected to decide in favor of that request, but were not obligated to do so. So they retained the decision whether or not to extend the principal payment. In addition, in those cases where interest needed to be restructured, we gave some provisioning and classification incentives that if a bank worked out a new repayment schedule with the borrower, including interest payments, the classification and provisioning would be on the basis of the new contract and not the original contract. And this gave an incentive to the borrower because then they would not get reported to the Credit Reporting Bureau as an overdue client. And it gave an incentive to the bank because a bank, once it undertakes the provision, often loses the incentive to try to reach some kind of a restructuring of the financial obligations. Now, between a combination of these two measures and largely due to only principal extension, about 900 billion rupees were utilized under this scheme. 900 billion rupees is around, say, $6 billion US, roughly in that range. And I told you that as regulators, we were very keen to preserve the credit culture. Therefore, we did not make it mandatory. Yet, we had to figure out a way that because we knew banks were going to become very, very risk averse, they don't say no to every single client that walks in their door just because they've become hyper risk averse. The trick or the tool that we used was weekly reporting from the banks about the number of applications that they were getting for principal extension and interest restructuring, and the number of such applications that they accepted and rejected. We were able to compare this across banks in the industry, and we were therefore able to very quickly detect if some banks were being a lot more risk averse than other banks in terms of accepting applications for principal extensions. And the only requirement we had was when a bank decided to reject such an application, that the bank provide an explanation to the central bank as to the reasons for that. Just this signal that the central bank was observing carefully the rate at which banks were accepting such applications and comparing it across the industry provided the needed signal that we think was very helpful, that in general, because we expect this crisis to be temporary, we do not want liquidity problems to become solvency problems. And today, when I see the results of this policy nearly 9 months afterwards, I'm happy to share that we've, in nearly all sectors except hospitality, we have had activity come raging back. And to give you one example, monthly car sales were at a time flat. And the most recent number on those was about 40% growth year on year. And at the same time, our net NPLs ratio, NPLs net of provisions, is a little bit less than 2%. And it has roughly stayed at that level. So we are continuing to monitor asset quality developments in banks' portfolios very carefully. But because of the de facto injection of a lot of liquidity, we believe we ended up avoiding a lot of insolvencies that later on would have actually become very problematic. Later on, perhaps in this talk, I can speak briefly why in Pakistan it's very difficult to do a corporate workout, partly because of the intricacies of the judicial system. So I very much welcome the presence of lawyers on this panel, and partly because of a culture where previously in Pakistan's history, some borrowers have used strategic default to basically set up questionable activities and then get a free bailout. And the combination of weak corporate governance, judicial system issues, makes it difficult to do corporate workouts. So that's why we were keen to not have a rise in insolvencies, because then that stock of non-performing loans would have taken a very long time to resolve.
Very interesting, Reza. So you just tapped the ball down the road very softly as opposed to give it a good hard kick and bought yourself some time. We certainly have seen in many of our countries of operations liquidity rising at banks because of, some sense of trepidation in terms of continuing to lend. But Ramiro, I want to come to you because I think Reza said something interesting about, government involvement. Rosa was talking about it a bit, and unlike the developed world where some of the airlines were bailed out by their governments, we actually first met when LATAM was trying to figure out should they do a restructuring, because you didn't have a government that was willing to bail you out. So as part of the process, you've decided that you would undertake a restructuring, and you determined to do that in the United States using Chapter 11. What elements did you think would benefit LATAM by coming to the United States and using the legal and regulatory framework in the United States for that bankruptcy?
Thank you, Stephanie, and good morning, everyone. A pleasure to be sharing the panel. The U.S. bankruptcy process was an attractive forum for us for several reasons, Stephanie. It first enabled us as LATAM to file one collective proceeding for all of our affiliates. As LATAM, we have affiliates in Brazil, in the United States, in Peru, in Colombia, in Chile, in the Cayman Islands. So having one collective reorganization plan was very important. We thought that having consistent application of the automatic stay, having a broad jurisdiction over our major creditors, having the ability to work one unique timeline, and having a specialized bankruptcy court were all important factors when considering the decision making. And this links very much to what Hal was saying at the beginning, having a clear regulatory framework. A second point that was important to us relates to Jamie's first comment regarding liquidity. As you well said, we didn't have government support, and liquidity was key. When we filed, we had 1.6 billion in cash, And we knew that we needed additional cash to get us through the pandemic. And the US bankruptcy code provides for a minimum full protection for DIP lenders. It enabled us to secure financing, concepts or features like the super priority status for DIP loans, or the potential to prime existing liens are less common in Latin America and are a facility under the US Chapter 11. And that was beneficial for us to raise additional 2.5 billion during this period. So liquidity and a clear regulatory framework were important factors. But as an airline, you know that we are facing very uncertain times, and the recovery curve that we are foreseeing is still to be determined and will be affected by the pandemic. So we also considered as an important factor that the US process does not have specific short required timelines to complete the restructuring and reach agreement with the creditors. When you look at Latin American jurisdictions, many of them have specific timelines, and certain exemptions are required from creditors that exempts them from participating on the stay. As a last point, maybe the US has precedents for successful airline restructurings, and many of our suppliers, the aircraft lessors and major vendors that we have, fuel suppliers, ground handlers, are familiar with the concept of the Chapter 11. So this gave us an opportunity to better have more constructive discussions with them, understanding the whole process.
Very interesting, Ramiro. And it brings me back to you, Jamie, because I think what Ramiro said is they chose the United States because it had a very mature policy and regulatory environment that lenders, suppliers, creditors could understand, and that the DIP financing really helped them with liquidity. So you do work for a very large international law firm, and you were the president of Insol International. So you must be talking to insolvency specialists around the world. I'm curious if you're seeing any governments who you think are really leaning in and doing the right thing. And my second question is very much to what Ramiro said. Are you seeing an uptick in cross-border filings in decisions taken by companies like LATAM in the United States or in other jurisdictions that seem to have better policy and regulatory regimes?
In a short answer, yes, to the last part, but let me go a little bit broader. I think, obviously when we talk about insolvency or restructuring or bankruptcy, however you want to characterize it around the world, I think we all know that it's not just a regulatory regime. We've heard from all of the esteemed panelists bringing different perspectives to it, but it really takes into account not just the legal regime, but I'll call it social issues, political issues, cultural issues, and a lot of other issues. So I wouldn't say there's been one size fits all response around the world. It's been very bespoke as to individual countries, but more broadly, you've had a lot of the EU countries relax restrictions. New Zealand has done things. Australia has done things. U.S. has done a couple of things, and it kind of depended on each of their individualized situation. But you had a relaxation of requirements to file, that is potential personal liability of directors for delaying a filing. I think that was incredibly important because, as was noted, distinguishing between a liquidity crisis and insolvency was a little bit difficult, and still is maybe in the age of COVID. And so that relaxation gave more flexibility that companies didn't have to precipitously go into a insolvency filing when there was just massive ambiguity and lots of fluidity. You had some countries come up with sort of the U.S. equivalent of the automatic stay. Most of these have been temporary. When they're going to roll off and how's that, I think will also be bespoke, because the solution to the crisis is at a different timeline in a lot of different places. You had other solutions, obviously government aid coming to the fore as mentioned, the $6 billion in Pakistan. Obviously, we've thrown a lot of money at the situation in the U.S. We did, for example, in the U.S., we talk about all of our big, huge bankruptcies that people hear about, in the newspapers. But really, more importantly, we actually enacted, independent of COVID, right before COVID, a small business chapter of the U.S. Bankruptcy Code. But the limits on the filing were very low dollars. I think it was $1.5 million. And they temporarily raised that amount to $7.5 million. And that actually covers 85 to 90% of U.S. Chapter 11s. And that's a much more streamlined process than the one LATAM is going through, which you heard a lot of the good parts of it, but it is kind of clunky here and there and an expensive process to go through. And the small business process was intended to make it more expeditious, efficient, and cheaper for professional fees. And in fact, just this week, there's been legislation introduced in the United States to further extend those limits from expiring later in March of 2021 to later this year, or even maybe into next year. So I think the response of the world has actually been, very constructive, almost, by force. Where this goes over time, because when I mentioned the distinction between liquidity and insolvency, first you got to solve the crisis and live through the crisis. What's going to happen as we get deeper into this and over time? I do think, unfortunately, the overhang will go on for quite a while, and everybody on this call and the World Bank will be quite relevant because to save themselves, so many companies around the world and yes, on a cross-border basis, have taken on extreme amounts of leverage, and that over time may not be consistent with being able to grow into or live with the current capital structure that resulted from that. And so there will be some long-term repercussions as to how to deal with all that.
Very interesting, Jamie. Hal, I want to come back to you because one of the things you said about your experience in Japan was that the banks kicked the can down the road. So the problem really started with the banks. The interesting thing about COVID is the contagion actually started in the private sector and is kind of being forced onto the banks as a result of a lot of the regulatory forbearance we've heard everybody else say was necessary to provide liquidity. What's the timeline, do you think, for leaving those kinds of temporary changes in place? And how long will it take before we know whether or not we've made the right choice vis-a-vis the banks and this sense of building zombie firms? Do you have any sense? I think you're on mute, Hal.
Okay. Well, I'm not really great at predicting the future, but I will take you up on your point, which I think is very central to understanding what's going on here. In 2008, as you said, we had a problem in the financial system that sort of reverberated out to the real economy. All right. And in COVID, it's the opposite. Okay. We had a virus which impacted the real economy immediately, and we're worried about its reverberation out to the financial system. So, I think it's important to understand when you sort of think about how to deal with that, that it was very important to give aid to the real economy. And one of the things that has been mentioned is a kind of forbearance policy. But there were other measures that were taken, at least in our country. We created subsidies to small and medium enterprises through the so-called PPP program. The Fed created a liquidity facility for small business, medium enterprises. As Jamie says, liquidity is essential for them. So the Fed, the central bank, created a lending facility. It wasn't all that successful because our Secretary of Treasury didn't want to lose any money. I've written a number of op-eds on this issue. But the point is that we created a liquidity facility from the government and kind of recognizing the point that this was a short-term problem. People could pay this back. We had an enormous liquidity problem in the small and medium enterprise sector. So I think this is, along with kind of a forbearance, this is an important element. But at the end of the day, there's a concern that the policies of forbearance could lead to bank problems. I think that was in the last decade. These were structural issues in the economy of Japan. We're not going to go away. Okay, COVID's different. It may go away. Okay, and we don't really know how quickly it will go away. So pushing the ball gently, as you put it, down the road in a COVID situation, to me, is probably a lot more acceptable than it was in Japan, because in Japan, you have structural underneath problems weren't going to go away in the Japanese system. Here you have a virus that could go away. Now, the last point I would make is, I think global banks are in great shape. Credit Lyonnais, Société, Générale, French banks, I don't think they have much to worry about. I think the problem will be in local banks, within these countries. And there you could see insolvency risk as a result of these policies, even with a, resurging economy, because the question is, how much loss have they really got on their books? All by saying that I think it's very important not only to have a good bankruptcy system for industrial firms, you need a good resolution system for banks, okay? And again, a 2008 takeaway that we had, because we were concerned with all the money we were injecting into these banks, was to create an entirely new resolution system called Orderly Liquidation Authority that could be used for systemically important institutions, which I would say would be, any major banks in emerging markets. And that facility, gives liquidity to these institutions. Banks need liquidity probably even more than anyone else. Okay, so if banks don't have liquidity, they really can't operate. And so I would say a lesson going forward here for these countries, if you don't have this kind of system now, and of course the G20 and Financial Stability Board have been advocating the creation of these systems, but I think it's very important going forward the countries, give added attention to their creation.
Very, very interesting. Okay, Rosa, let me come to you. From a perspective of a creditor, so putting on your banking hat, how does this crisis, where borrowers are financially vulnerable due to the pandemic, differ from past crises in terms of what you've seen in your kind of refinancing and restructuring business? And how are you seeing your distressed asset portfolio growing? Are you seeing a substantial rise? Do you expect to see a substantial rise?
So, as a matter of fact, this crisis did not affect all the sectors in the same manner. Hotels, restaurants, leisure, tourism, travel have been affected, whereas, for instance, the food distribution, which was not in a very great shape before the pandemics, could fix its performance thanks to the pandemic. Looking closer, we can see that the most vulnerable sectors, such as that I mentioned, had already been facing transformations due to social and cultural factors, which were pushing them to change. The society today is much more sensitive to eco-responsibility, carbon emissions, ecology, and anti-waste. And this started some time ago, before the pandemics, to influence people's choices in traveling, eating, spending. In fact, what I want to say is that pandemics has accelerated those societal changes. People would continue ordering food, but maybe they will eat in a place of their choice, at home or somewhere else, and not in a restaurant. We saw even in our industry, we have not traveled a lot, and yet we stayed very close to our clients and to ourselves. And the business travel is an area where changes might be sustainable. So this is one difference with the past crisis we saw. Another big difference was the nature of the measures applied. It is the first time that there was a direct fiscal and budgetary response. People were getting their envelopes directly in their mailboxes. So these were measures that were targeting survival and not stimulus or something else. As we speak, we do not yet see a huge peak in insolvencies coming. And even in France, we have a drop, a 30% drop in corporate insolvencies. There is liquidity, but there is lack of visibility. And of course, we all expect the impairment and the bankruptcies and the insolvencies to pop up in the coming months. Now, speaking about restructuring in general, even though every country, every framework, and every case is different, of course, we need a classical set of pillars like pre-insolvency and insolvency proceedings, efficiency in the enforcement measures, provisioning and write-off rules, and also more and more development of a secondary market to allow the non-performing exposures, sales. And on this last topic, the key factors driving the loan sale market include regulations, prudential backstops, high capital requirements, but also the presence of investors and liquidity, and investors willing to put their liquidity in this class of assets. I previously worked in some Eastern European countries, and after 2008, in the aftermath of 2008 financial crisis, there was barely a secondary market for NPL sales. It is to tell you that today we see those global firms that came from the USA got developed in Europe, and they are stretching to new geographies, and they buy out from those geographies where they were not present before. I speak about it as I believe that banks need efforts from public-private participants to create such ecosystems in emerging countries where it does not exist, so that we have an option to take out, to remove the NPLs from our balance sheet and to focus ourselves on producing new loans, because all the economies will need this type of actions from the banks.
Very interesting, Rosa. So our distressed asset business is growing, and one of the things that we try to do is bring distressed asset companies from the developed world into emerging markets for this very purpose. And your point about, so our third R is resilient recovery. It's really how do we take some of the social learnings and lean in on climate and other things that are important for our society going forward. But Reza, I want to come back to you because I think we heard Rosa talking about the need, well, the lack of visibility in terms of, is there going to be a wave of insolvencies coming forward? Hal was really talking about, the critical learning is that we need to think about resolutions that help systemic institutions. So in Pakistan, as you look, you've done a good job tapping the ball down the field. And you mentioned that it's very difficult to do restructurings and insolvencies in your existing landscape. What are you thinking about longer term in terms of policy and regulatory change to improve the environment in Pakistan from the learnings of this COVID crisis as we come out of this COVID crisis? Anything specific you're considering?
Yes, I'd like to talk about, I think, the most important area for Pakistan, and where, in fact, help from institutions like the World Bank can go a long way as well, is creating expertise in the judicial system to be able to hear cases pertaining to insolvencies, having specialized benches of the courts, specialized judges, and using also technology to try to address the backlog of such cases that exist. But before talking a little bit more about what we are doing specifically, I did want to comment on one thing, Stephanie, about tapping the ball down the road, because two things are observationally equivalent. One is to just kick something down the road and it becomes a bigger thing eventually. And the other is that you provide some liquidity, but then it ends up reducing the amount that you would have to restructure. And I want to tell you a little bit about why in Pakistan we felt we were in the second camp, is because we have a banking system that historically has been quite conservative. Let me share some numbers why I say this. Even before going into the COVID crisis, the average capital adequacy ratio of banks in Pakistan was around 19%. 19%. The credit to GDP ratio is less than 20%. It's not a very levered up country. The provision coverage ratio was about 80%. And if you see these numbers, you realize that we are dealing with a financial system where banks very hesitant to lend, and partly it's crowding out because the government runs a big deficit and banks are very happy to lend to the government and not lend to the private sector. So we entered the COVID crisis from this situation, and we recognized quite early that this injection of temporary liquidity, and by the way, these schemes have now expired. They expired a few months ago. They have actually, we are quite confident, reduced the amount of restructuring that will need to happen. And I should tell you that since the 9 months of which we have data, our non-performing loans have increased by about 23 billion rupees. I told you the exchange rate is about 156 to the dollar, but the provisions have increased 4 times more. So the provisions have increased by 72 billion compared to the 23 billion increase in the non-performing loans. So I think I wanted to make that point about how we don't know the counterfactual. We don't know what would have happened if the ball had not been tapped, but we feel quite, we are quite clear in Pakistan that we would have been dealing with a much bigger problem. Now in Pakistan, what we did was we created a company called the Corporate Restructuring Company, which is the first time it's a privately owned company that has been set up where the owners are banks, which has been set up primarily to deal with those problem loans where there are multiple creditors, because in such loans, there is an issue of inter-creditor coordination. And this corporation has been set up to basically get loans, non-performing loans transferred to this company. And then the management of this company undertakes the workout and realizes the coordination that is needed across the different creditors. But what will really be needed in Pakistan to resolve distressed assets better is a partnership of working with the judicial system. So what we are doing is we've been working with the government for the creation of dedicated benches to be established at higher courts to hear the litigation under this corporate restructuring company that we have created. Because if we don't have that quick resolution in the courts, this company will not be very successful. Second, we are entering into memorandum of understanding with provincial governments and the high courts in the provincial governments to promote the interaction between central banks and the judicial officers. One of the issues that we find is often sometimes in the courts, the judicial officers do not recognize very well the drag of NPLs on private sector credit growth. They don't realize very well that even if there is some amount of moral hazard, one has to hold one's nose and realize and achieve a workout so that the asset is written off from the bank's books and the borrower is able to re-engage in activity. And sometimes it's not very well targeted because there may be cases of strategic default, but that comes about with any public intervention. And just like with subsidies, we have to hold our nose a little bit and work in that bigger good. And finally, we've been working with our Securities and Exchange Commission for notifying a panel of insolvency experts so that this company and act that we have to facilitate rehabilitation can be operationalized. But if there's one word that I can say is the following, that, you know, by training, I'm an economist. And at the IMF, I worked a lot on sovereign debt restructuring, where we always used to remind ourselves that we wished we had Chapter 11 for sovereigns, because if we did, sovereign debt restructuring would be a lot easier. Now, when I deal with corporate restructuring, what I realize is that being an economist is not enough. You really need lawyers and judges to get anything done in this space, and having that partnership and some technical assistance from international agencies is, I think, going to be imperative and critical for us to achieve some corporate workouts.
Thanks, Reza. I've been working for 29 years, and I must say lawyers are important. Ramiro, I want to come to you because I want to come. You've heard a lot about the need for policy and regulation, where it works, where it doesn't work. I think Jamie said the Chapter 11 process in the U.S. is clunky at times. So I want to really hear from you. You are in the throes of a Chapter 11. Was the decision to go that route the right one? Does what we've heard from panelists resonate in terms of what you at LATAM are experiencing going through the crisis?
It does. I think it resonates. We're still in the process, right? We're 10 months into Chapter 11 now, so we're in the middle or maybe 2/3 of the way down. I think it resonates, Stephanie. I think there were lots of benefits that we discussed through the conference today in terms of Chapter 11. We mentioned the dip, we mentioned the stay, we mentioned the possibility to exit and renegotiate certain contracts. One that we didn't mention, I think, and that for us was particularly important, is that usually when you compare the U.S. chapter to Latin American proceedings, in Latin America, you often link the bankruptcy to a liquidation status, more linked to the insolvency procedure. And in our case, and I think many companies are going through this, it's more a liquidity issue. We were a healthy company before. We were generating cash flow for many years. We were a growing company. We were very well positioned in the market to continue to grow. And we found a working capital issue with a lack of sales from the second quarter in 2020 onwards. So it's a liquidity issue, and we were really concerned on how to address this with our customers. And the Chapter 11 allowed us to be very candid with our suppliers, with our lenders, with our customers about the liquidity situation of the company, and to focus the conversation more to the transformation that is needed from a company perspective and the industry perspective. So I think that's a benefit that we haven't discussed through the panel. But there are certain things, as Jamie put it, it's a complex process, and in our perspective, this being such a public process is beneficial to the stakeholders, but it adds significant cost to the process in terms of disclosure, in terms of reporting, in terms of motion practice. So we had to layer as a company the bankruptcy process into our operations. So we had to do both at the same time. This put additional pressure into additional procedure, approval, disclosure requirements that are complex, and that requires a lot of work and time and cost, as Jamie put it. And another aspect that for us was clunky, if you want to use that word, is that we had to explain to many of our vendors and other stakeholders the U.S. Chapter 11 process. That wasn't easy. Some of our vendors and some of our stakeholders are very familiar with the chapter, but others are not, and we need to familiarize them with the process and to help them operate within the structure of the U.S. bankruptcy code. All in all, I would say that for these 10 months, there is more to like than to be affected by the clunky procedure that we were discussing, and we're happy with the decision we took.
Great. So I have a couple of questions that we don't have much time left, but I do want to take a couple questions that have come in online. And while I do that, the last question I'm going to give to all of you is, what is the one recommendation you have for the World Bank Group in relation to restructuring and refinancing as we come out of the COVID crisis? So be thinking about that. But I'm going to start with you, Ramiro. One question that came in online: you must have been following the cases of Colombia's Avianca and Mexico's Air Mexico. Do you see a pattern there, or there are substantial differences in the way the three cases are being developed?
I have been following the cases, of course, as we have been following other cases in the travel industry. Maybe Hertz is another example that is ongoing. I think the three cases move quite in parallel, but with very different process in terms of timing. I think that we have all secured additional financing. We are all currently renegotiating our fleet agreements. and I think that we're all heading towards the same solution in terms of when thinking about the exit financing of the company. However, the timing of the different negotiation is not running at the same pace than we are, and the conflicts that we had throughout the process are different. Some of us had to face a little bit more struggle when discussing deep financings. Others had a simpler solution to that. But I think the processes are more or less in line and are advancing in a common path.
Great. Jamie, maybe I'll come to you next because we just talked about 3 cross-border bankruptcy filings in the U.S. Question for you is, what do you expect in terms of further U.S. bankruptcy filings by foreign companies? And have you experienced any major problems with getting rulings on U.S. bankruptcy courts recognized in foreign jurisdictions?
The process of filing a case in the United States for foreign companies is amazingly simple. Literally, if you pay a retainer to your U.S. lawyer, that can be grounds for jurisdiction for filing a case in the United States. So I would expect you'll see more for all the reasons that we're hearing described as to why LATAM filed in the United States. And I'm not ethnocentric enough to say that we have the best system. And when I talk about it as clunky, that might be on an absolute basis, but the world is always compared to what, and we can't compare it to nirvana. We need to compare it to the available alternatives. So if it's the right place at the right time, I think there's a lot of possibilities. In terms of the recognition of what goes on in the U.S. for a company that files in the U.S. that may not have tremendous connections to the U.S., we really haven't had that many problems having those rulings enforced. There's generally, if the creditors involved in the case are also involved in the U.S. financial system, which is, as we all know, casts a pretty wide net, they're going to comply with the rulings of what happens in the U.S. because there's potential legal consequences to their other businesses if they don't. There have been aberrational situations way back when there was a UCOS filed in the United States, and everything they did was located in Russia, and pretty much they could thumb their nose at anything the U.S. Court wanted to do. That case ultimately got dismissed for those reasons, that it was utterly impossible for the judge to enter any enforceable orders. So I think that's maybe a broad strokes way of looking at it. But as I say, I think folks in determining what jurisdiction to file in need to study the benefits and burdens that apply to their own individualized factual situation.
Thanks, Jamie. Reza, there's one last question here for you, which is important to me as the Senior VP of Operations for IFC. And the question is that restructurings often require additional capital and fresh funding. Where do you see that capital coming from in Pakistan?
Well, I thought you were going to offer that the IFC is considering putting in capital for these restructuring. And had you said that, I would have told you you're very welcome. And we'd be happy to talk to you. But look, we've set up a private company right now where the seed capital has been put in by the banks themselves. We are looking for strategic partners, including international firms. And on a serious note, I think one area where IFC can actually help us is to leverage such an investment from happening. If an international workout firm sees that the IFC is working with us and helping us resolve, helping us to ensure that this company resolves distressed debt in a good manner, then it's a good signal. And I think that's one way to catalyze private capital. Failing that, we would need to get the government to inject some capital, but that always makes it more messy because we have also a very active anti-corruption judicial system, and anything that the government does then is subject potentially of a lot of inquiries, judicial inquiries. And then it has an impact on the interest of private parties to participate in any such transaction. So to the extent that we can do it private capital driven, including foreign capital, we are very keen to pursue that. And I will tell you, I worked on the Asian financial crisis in the earlier part of my career. And, the Asian financial crisis created a lot of distressed corporate debt. And if you look at the approaches taken by different countries, Korea, which was the quickest to turn around, versus Indonesia, that I think was the slowest to resolve its distressed debt assets. Korea basically did a fire sale, more or less. It allowed foreign investors to come in. It ended up selling assets at very quickly negotiated prices. But guess what? Korea had a V-shaped economic recovery because that overhang of corporate debt was immediately taken care of. And in Pakistan, we have the situation where although the stock of bad debt is not that high because the stock of loans is not that high, a lot of these loans are very well provisioned. And therefore, the bank loses the incentive to do anything about it, especially in a system where there is judicial complication. So we welcome a private sector-led solution to work these things out. And just separately, Stephanie, I'd also wanted to mention for the benefit of your audience that Pakistan is also undertaking a insolvency ROSC, the insolvency report on observation of standard of and code. And we are very much looking forward to taking that forward. And the central bank is actually playing the coordinating role of getting all the other government agencies on the table so that we are able to implement also the recommendations that come out of it. And we're very excited about that work that is underway.
Great, Reza. I'll make sure I send Alfonso your way for business. Okay, we have just about a couple of minutes left. Very quickly, one ask that you have of the World Bank Group. Jamie, let me start with you.
Had to get off mute there. What I would say is I think the World Bank should keep doing what it's doing. And we heard from various panelists about the importance of the regulatory regime and the judicial function. I think one of the things that we do around the world is a lot of out-of-court workouts. And out-of-court workouts depend on a really good in-court regime that people trust and kind of know what would happen if it went in court as a method by which to avoid going into court. And that usually is less costly, quicker, and more efficient. And the one other thing I would mention on that, and I think the World Bank has been excellent on that and can keep doing that, is what I call the ecosystem of the restructuring world. So it's not just the judges and the government and the World Bank, it's all of the professionals. I know LATAM has wonderful bankruptcy lawyers and investment bankers, and that's incredibly important to develop and nurture that expertise so they can advise all of the folks on this call from banks and government banks and companies around the world as to how things can be done in a out-of-court way. And I think the World Bank can be a great incubator of that, and it's already been doing that, of putting all of those strands together to make for a more impactful and effective and efficient insolvency process, or avoidance of the insolvency process even better.
Excellent. Rosa, do you want to come in next?
Yes, thank you. I think that World Bank can favor sharing the best practices and create a kind of induction process for specialists to go from developed countries to developing countries. Also bring liquidity where it will be lacking, and as everybody mentioned, contribute to the creation of ecosystem for the restructuring and for the secondary sales of NPLs. And thank you for what you are doing already. Thank you.
Thank you, Rosa. Hal?
Well, there's an element of self-interest in this, but I do believe that it would be important for the bank to support educational programs that are focused on particular problems of a given country. And that's quite different, I think, than a consulting role where you bring in an expert to solve a problem. I think there's a role to educate, people, by the way, in developed as well as developing countries, how to think about the problems that they're most concerned about.
Great. Reza, do you want to come in?
I mentioned the ROSC, that I think is a very good initiative on the part of the World Bank. It's an ongoing thing. But over and above, I would also really emphasize the importance of technical assistance, both from the World Bank and perhaps even from the IMF, in reforming and strengthening the ability of the legal system and the judicial system, the courts, to dispose cases pertaining to corporate debt workouts, and in particular, using technology for that purpose. I think there are some examples where programs like these have been done successfully, and I think they go a long way to raise the appetite in the private sector and the banks to do these corporate workouts.
Great. Ramiro, how about you?
Well, I agree with everything that has been said. Maybe a final thought from my side would be that a liquidation process, in my opinion, can be value destructive for companies, for stakeholders, and for economies. So everything that we can do, either to encourage countries to update and modernize their insolvency laws, to help otherwise healthy firms to being able to make in a restructuring, I think that effort is very much valued.
I fully agree with you. Makhtar, would you like to jump in at the last minute?
Yes, a few was maybe some of the things related to Reza, because of the common background that we had. I was at the IMF at the 98 crisis, so I saw very closely how the question. I think you raised a very important point, and I think that the ROSC of today will be different from the ROSC of that time, because of the channel, the transmission. And I think that one of the challenge that we have is to think really about the new ROSC that will be put in place. We think more about ecosystems and looking at some specific channels in terms of insolvency of the banking sector. So it will be very important to get feedback from you as practitioner from the central bank about how you see specifically the way we could be reshaping the ROSC to take into account that new reality, and particularly the fact that with the fintech and the progress that has been made on technology, we will have some response. For instance, there are some recent paper which was interesting to show how the fintech has been slowing down the capability of the monetary policies that has been pushed by the central bank because of those channels. So you have new questions that we didn't have in 2008 that I think that will be important. That's one of the big lessons for me in looking forward and to think about the ecosystem. I couldn't more agree. I fully agree with Al on education. We have a program on education that we're trying just to launch on the capital market, training regulator on capital market for training. And I think that adding a module on solvency and bankruptcy will be a good element. And maybe we can be touching base with you later on to see how we can collaborate on these issues. We have started this program in the US, maybe because we wanted to reach more of the emerging economy. Now we are doing it with a French university to be able to reach people who are speaking French, and we'll be certainly working in Latin America with that. So just the 2 points that I wanted to make, and I will not talk about the judiciary because everybody talk about it. But I think that thinking about the ROSC differently will be very, very important as we go. Stephanie, back to you. And
thank you very much, Makhtar. We are wrapping up. I want to thank all of our panelists. This has been an incredibly rich discussion. I could have kept the conversation going a lot longer, but I took away 4 key things. First, liquidity is king, and we need to triage cash. Second, we should recognize problems early and act quickly. The third is to pay attention to debt overhangs as we come out of the crisis and think about where we have structural issues in areas like retail might be one. And finally, as we come out of the crisis, we really do need to think about how we build back more resiliently taking into account social change, climate, and building on the ecosystem of the bankruptcy and insolvency regimes, which we will certainly continue to focus on. So thank you all very much for your time. I hope you have a lovely weekend. And we will have the third session shortly.
Thank you. Bye-bye.
Thank you.